The 10-year US Treasury hit the 5% mark. Now, that's not only the highest levels in over 16 years, but it is unbelievable. It's telling us a lot about what's happening in the US economy, what's happening with bond deals, and what the impact is going to be on emerging markets, including ours. They did go back a bit after hitting that 5% level, but that mark itself is an important one. The biggest reason seems to be statements made by the Fed Chair, Jerome Powell, in a private event yesterday. But what Mr. Powell essentially said, that the Fed is resilient about their goal to bringing down US inflation at 2%. It's currently on an annual basis at around 3.7%. And he sees the economy having to slow down further to support a cooling off of inflation. In fact, what he specifically said was the record still suggests that a sustainable return to our 2% inflation goal is likely to require a period of below trend growth and some further softening in labor market conditions. Labor market conditions is an important point because yesterday you had the unemployment numbers that came out in the United States, and they were lower than expected. What that means is that wage rates will be higher, which will feed into higher inflation. In fact, the US economy has been surprisingly resilient to all these rate hikes and the effort of the Federal Reserve to cool down inflation. There's one more factor, and that, of course, is crude, hovering around $93 a barrel. Because of all of the tensions in West Asia. Biden was in Israel yesterday. He's announced $100 million for victims in the Gaza area, but it doesn't seem to be nearly enough to really cool down tempers there. Let's come to the part about why this all matters. Well, why this matters, especially for emerging markets, is that when US government bonds have their interest rates hardening and going as high as 5%, it becomes an attractive option for FIIs who invest in emerging markets like India. We've already seen very large withdrawal numbers in September, the highest in the year, in fact, and the fears are that this could continue. And the reasons are fairly simple. Indian markets or any emerging markets relatively start looking like a riskier investment, and opportunities back home seem more attractive for FIIs. This is why bond yields going to 5% is such a big deal.